How do smart, high-income investors still lose money in safe multifamily deals? Not in speculative land, not in crypto, not in startups. I'm talking about apartment buildings, the asset class everyone calls stable, predictable, and durable. And yet, every cycle you see the same story. A deal looked great on paper, the deck was beautiful, the returns were impressive, the operator seemed experienced, and then 12 months later, distribution's slow, then come the excuses, then comes the capital call, and by the time the investor realized what happened, it's too late. I'm about to show you how that risk was embedded from day one and how you can spot that risk before you invest. And here's the part that should make you super uncomfortable. Most deal failures aren't caused by a single dramatic event. They're caused by a process failure. The underwriting wasn't layered. The assumptions weren't verified. The operational reality was never tested. So in this video, I'm going to walk you through what we call our 5-layer risk compression system, the underwriting process we use at Elevest Capital before we ever submit an LOI. This is the exact process we built over 20 years to eliminate unnecessary risk before we ever deploy capital. This is how we avoid most landlines before we're emotionally attached to a deal. And midway through this video, I'll show you why we intentionally do something that sounds completely backwards at first. And if you invest passively, or you plan to, this is the difference between hoping a deal performs and knowing the structure can survive. Let's get into it. If we haven't met yet, I'm Adam Williams, founder of Elevest Capital. I've spent over 20 years exclusively investing in multifamily real estate. Last year alone, we completed over $200 million in transactions, and we added more than 1,300 units to our portfolio. We don't win by chasing great deals, we win by declining the wrong ones. And the one way to do that consistently is to have a repeatable underwriting process that doesn't rely on emotion. You see, most investors think underwriting is one thing. They think that it's a spreadsheet or a pro forma or a return projection. But real underwriting is a filter. It's a sequence of gates, and each gate is designed to answer a different question. Does the deal pass the common sense test? Can it pencil with realistic data? Can we verify the upside on the ground? Can it survive diligence and real vendor pricing fluctuations? Does it still work when you stress test the 2 variables that matter most? And that's what a 5-tier underwriting system does. It prevents you from doing what most investors accidentally do. They start with the return, then they build a narrative to justify it. See, institutional underwriting is the opposite. You start with how it breaks, then you see if the deal still deserves capital. So here's how the 5-layer risk compression system works. 5 layers, 5 gates. Each one is designed to compress risk before capital is ever deployed. Most deals die before layer 3, and that's the point. Tier 1, the sense test filter. Tier 1 is not deep underwriting. It's not a pro forma. Tier 1 is, does the deal even deserve our time? Because deal flow is endless, but good deals are not. So when a deal comes from a broker, an owner, a lender, even sometimes a lender post-foreclosure, we intake it into our deal tracker and we populate everything that we can find that's public and qualitative. Then Tier 1 checks 3 things: crime, safety, and reality. We look at the crime data. We review reports that indicate the level of violence in the area. We also look at tenant sentiment, primarily on Google reviews, because residents will tell you what's happening long before the pitch deck admits it. And we don't pretend there's a perfect rule. We operate in workforce housing, which means that we see some rough edges. But if we see some red flags out of the gate, things like repeated violence offenses, that's a hard pass for us. Not because we're afraid of hard work, because we've learned this the expensive way. Operationally, it's hard to turn that environment around. And from a lender's perspective, those assets become hard to finance. So we avoid any property below a Class B and in a B+ or an A area. Income reality. What rents can this area actually support? This is where most investors get misled. They see a renovation plan, they see projected rents, but they never ask, is the tenant base there? We look at median household income in a 1, 2, and 5-mile radius. Then we take the highest of those and we give it a 20% haircut. That's our way of targeting roughly the 80% AMI threshold. Then we ask, if the property's current average rent is X, what does the local income profile suggest is the maximum rent supported? Is there a meaningful delta? If there's no delta, there's no value add. If the delta exists, then we move forward. The buy box plus the obvious deal killers. Does it fit our acquisition criteria? And are there obvious killers like excessive deferred maintenance that we can see early, operational chaos implied in the reviews, rent story that doesn't match reality. You see, here's the truth. A huge percentage of deals die right here, often half, and that's healthy. Tier 1 is designed to protect our time. Now here's where it gets really interesting, because if it passes Tier 1, we do something most investors wouldn't expect. We get more aggressive. Tier 2, the make it work underwrite. Tier 2 is where we do a full underwrite, but it's a specific kind of underwrite. It's intentionally aggressive, and that sounds dangerous until you understand the purpose. You see, Tier 2 is not meant to be the final truth. Tier 2 is meant to answer a single question. Can this deal get close enough to reality that it deserves boots on the ground verification? So we build the model using the T12, the rent roll, historical financials, market data sources, and whatever we can validate from third-party online data. Then we underwrite the revenues by looking at what nearby properties are achieving, often on a per square foot basis, and we push it. We try to make the deal work. Why? Because we don't want deals dying due to early analytical conservatism. If the deal can't pencil even when you're trying to give it a fair shake, it's not a deal. The number one reason deals die in Tier 2 is simple. The price is wrong. Cap rates too compressed, sellers expecting pricing that requires unrealistic leverage. You'll see sellers asking for a 3 to a 3.5 cap because they're pitching a tremendous value add. But the math becomes absurd. To make that work, you'd need a loan at something like a 40% LTV, and then raise the rest as equity. And even if you could raise it, the returns often don't justify the risk. So Tier 2 kills deals because of the capital stack, and that's the right reason to kill them. But Tier 2 is still theoretical. It's spreadsheet land. Tier 3 is where we start finding out what's real. Tier 3 gets into boots on the ground verification. Tier 3 is where we send our operations team to the property. We do the on-the-ground rent comp verification, we secret shop, we call the comps, we look at the asset with operator eyes, and we comp against properties we can actually become. And that matters. If we're buying an 80s vintage asset, we don't comp it against a neglected property being operated like a disaster. We comp against well-kept assets, renovated units, properties managed the way we would manage. Our team brings back real rent comp data and guidance on a finish level. For example, do we need a diamond level finish interior for renovations, or platinum, or gold? What rents are actually being achieved at that finish level? Then we update the model with their verified numbers. And here's what happens most of the time. Half to 75% of the deals die at Tier 3 because Tier 2 was intentionally aggressive. And Tier 3 is where the market says, nice idea, not happening. This is a critical lesson for passive investors. A deal can work in a spreadsheet and still be unbuyable in reality. See, Tier 3 is where we separate narratives from facts. If a deal passes Tier 3, then we move to the next stage. That's when we submit an LOI. Tier 4 is the pre-LOI verification and contract diligence. Before we submit an LOI, we've usually already secret shopped the property, looked for invisible deferred maintenance, asked key historical questions. We'll ask things like, any insurance issues in the last 5 years? What about the roof condition? Plumbing history? Electrical issues? We're not trying to be dramatic. We're trying to budget accurately. Then if the LOI is accepted and we go under contract, Tier 4 becomes full diligence. We walk units, we hire vendors to inspect roofs, electrical, plumbing, we bid renovation scopes. And this is where underwriting gets real, because now you're not guessing what renovation costs. You're getting competitive pricing. We'll often bring in 4 to 5 vendors and say, here's the target interior budget, this is what we need for a 1-bedroom and 2-bedroom, and whoever can hit it and execute gets the job. And the goal is not to nickel and dime vendors. It's to build a repeatable relationship where scope and pricing are clear. At this stage, we also engage lenders to firm up the loan terms. And internally, we start building the investor materials. Tier 4 is where the deal either becomes real or it collapses under the weight of reality. Tier 5 is stress testing and sensitivity. Now, Tier 5 is the part that most investors never see, but we do. We don't always share the raw model because sensitivity tables require moving inputs and it can just confuse people. But we include the results in our data room. Tier 5 answers a simple question. What has to go wrong for this deal to underperform? Because we live in an imperfect world. So we stress test the variables that actually drive outcomes. And in our experience, the 2 biggest variables are exit cap rate and rent growth. Let's talk about why. If you assume 0 rent growth, most value add deals die. Not because they're scams, because the structure of a value-add deal requires rent movement to realize the business plan. So we model a realistic rent growth path. For example, we may assume year 1, 0% because of execution and turnover. Years 2 through 5, a stabilized rate around 3.25%. Then we run sensitivity. What if it's 2.25%? What if it's 1.25%? Now layer in exit cap sensitivity. If our target exit cap say 4.8, we ask, what if we sell at 5 or 5.3? Now you can see the range of outcomes. And here's the important point. We don't need perfection. We need resilience. If exit caps expand modestly and rent growth is nominal, we still want a deal to produce a credible equity multiple and a durable outcome. That's the difference between underwriting for marketing and underwriting for reality. So zoom out. The 5-layer risk compression exists for one reason: to prevent a single narrative from becoming a financial decision. Tier 1 filters for obvious mismatches. Tier 2 tests whether the math can even pencil. Tier 3 verifies reality on the ground. Tier 4 proves the scope with diligence. And Tier 5 stress tests the 2 variables that swing outcomes. If a deal survives all 5 tiers, it's not guaranteed, but it is disciplined. And discipline is what makes income durable. Let's quickly map out the 5 tiers to passive. Predictability, Tier 1 income reality, plus Tier 3 verified comps. Alignment, Tier 4 diligence, and fee scrutiny before we commit. Safety margin, Tier 2 capital stack, plus Tier 5 downside resilience. Scalability, Tier 3 operations validation and execution plan. Inflation resilience, rent movement assumptions, but verified, not hoped. Volatility exposure, sensitivity tables show how exposed the deal is. Exit clarity, Tier 5 exit cap scenarios, not a single point estimate. This is what institutional grade underwriting looks like. For over 2 decades, multifamily has been the engine I've used to build real wealth. But the engine is an asset class. The engine is structure, and structure is built in underwriting. We don't rely on optimism. We rely on process. My mission is to help people like you create real wealth and passive income through investing in multifamily real estate. It's how I built my family's fortune over the last 2 decades, and in my opinion, it's one of the most trusted ways to build lasting wealth, but only when discipline leads the way. There are 2 types of investors. The first reads a deck and asks, how good could this go? And the second reads a deal and asks, where does this break? And do we survive it? If you want to build lasting wealth, you don't need more deals. You need better filters. And if you want a disciplined second set of eyes before you allocate capital, visit elevestcapital.com and book a call with my team. We'll evaluate your goals, your portfolio, your income targets, and whether our strategy aligns with what you're trying to build. And in the next video, I'm going to show you exactly how we build a downside case, the exact stress test model we use to decide if a deal is resilient before we ever ask an investor to trust it. I'll see you there.